Welcome back to our channel. Today we will share with you what caused Silicon Valley Bank's failure. SVB Financial Group shut down and takeover by banking regulators on Friday the 10th of March 2023 can be traced to the U.S. Federal Reserve raising interest rates and souring the risk appetite of investors. Here is the sequence of events that led to Silicon Valley Bank's failure. First, Federal Reserve raises rates. The Federal Reserve has implemented a strategy of raising interest rates from their record low levels in the fight against inflation since last year. When the cost of money becomes more expensive as a result of higher rates, investors have less intolerance for risk. This adversely affected technology startups, which are the primary clients of Silicon Valley Bank, as it made their investors more risk-averse. Second, some Silicon Valley Bank clients face cash crunch. With increasing interest rates affecting the market for initial public offerings and raising the cost of private fundraising, some clients of Silicon Valley Bank are withdrawing money to meet their liquidity needs. In response, Silicon Valley Bank was trying hard to find ways to address these customer withdrawals. Third, Silicon Valley Bank sells bond portfolio at a loss. Silicon Valley Bank had to sell off a $21 billion bond portfolio mostly made up of U.S. Treasuries to fund the redemptions. However, the portfolio's yield was only averaging around 1.79%, which is much lower than the current 10-year Treasury yield of about 3.9%. This caused the bank to suffer a loss of $1.8 billion, which it needed to make up through a capital raise. After that, SVB announces stock sale. On Thursday, SVB declared its plan to resolve its funding shortage by selling $2.25 billion worth of common equity and preferred convertible stock. The news was followed by a 60% drop in the company's share prices as investors were concerned that the withdrawal of deposits might force the company to raise additional capital. And then, SVB stock sale collapses according to a report by Reuters. Certain clients of SVB withdrew their funds from the bank based on advice given by venture capital firms like Peter Thiel's Future Fund. This caused concern among investors, including General Atlantic, who had agreed to participate in the stock sale, and ultimately led to the failure of the fundraising effort on Thursday. In the end, SVB goes into receivership. SVB worked diligently to secure alternate funding, including exploring the possibility of selling the company. Unfortunately, on Friday the Federal Deposit Insurance Corporation (FDIC) disclosed that it had taken over the control of SVB due to its financial troubles. The FDIC announced plans to sell SVB's assets and cautioned that uninsured depositors may face delayed dividend payments in the future. Hope now you know what caused Silicon Valley Bank's failure. Thanks for watching. Please subscribe our channel if you like this video, and we will see you in next video.